Welcome to the 5-Minute Retirement Planning Coach, brought to you by Investor Solutions. Hi, so glad you could join us. I'm Frank Armstrong, the President of Investor Solutions. Today I'd like to talk about the critical need to get a decent rate of return on your retirement savings. As we've previously discussed, it's expensive to retire. For every $40,000 a year you need from your nest egg, you're going to need about $1 million at retirement. This isn't rocket science. There's 3 factors that determine whether you'll be successful: how much you save, how early you start, and what rate of return you get. As we've previously discussed, to accumulate your $1 million over 40 years at an assumed rate of 8%, you need to save about $3,500 a year. If you save less than that, there's no reason to believe that you're going to achieve your goal. Every year you delay starting to save for retirement, the annual cost of your contributions goes up. And at some point, it's going to be impossible to meet your goal because the savings required will far exceed your actual income. But if you wait 10 years to start, it's going to cost you almost $9,000 a year to reach your goal. If you wait another 10 years, it's going to cost you $21,000. Finally, if you've only got 10 years to go till retirement, you're going to have to put in $70,000 a year to make your goal. But it's not about just savings. You also got to get a decent return on those savings. For instance, if you get 8% rate of return, then you'll make your goal. But if you get 5%, you only make half your goal. And if you only get 3%, you only make about 30% of your goal. You won't reach your goal at retirement. In the investment world, rate of return is directly related to risk over the long haul. Keep in mind there are no low-risk, high-return strategies. You're very unlikely to meet your goals without assuming some level of investment risk. That means you've got to tolerate some degree of market ups and downs to get to where you want to be. Zero-risk strategies like CDs, treasury bills, and guaranteed accounts might yield you from 1 to 3% over time. Moderate risk strategies like long-term government bonds or corporate bonds might range from 4 to 6%. The more moderate risk portfolios, which include a high level of diversified stocks around the world, could range from anywhere from 7 to 11%. But if you tell me, look, Frank, I don't want to take any risk. Well, great, okay. You can do that, but let's say you get a 3% rate of return, you're going to have to invest about $12,500 a year instead of $3,500 a year. Most people really aren't willing to make that trade-off. So again, if you want to have zero risk in your retirement account, be prepared to invest enormous amounts of money to reach your goal. On the other hand, if you accept moderate risk, then the amount that you have to save to reach your goal is going to be something you can tolerate. By the way, I don't think it's wise to plan on rates of return in excess of 9%. It's not a good idea to bet the farm on the very best possible outcome. So in conclusion, in addition to actually saving money and starting early, you've got to get a decent return on those savings. Let's be clear though, I'm not advocating insane amounts of risk, but reaching your goal requires you to accept at least a moderate level of risk to get the rate of return that you need to get to where you want to be at retirement. You can't avoid risk, but managing risk and taking the right amount of risk at different points in your career is critical to your success. Using either target risk or target date strategies will manage the process for you. To get you on track and keep you on track, we have over 75 calculators on our site that'll help you plot your strategy. Thanks for listening. For more information on retirement solutions or investment solutions, just come to our site at investorsolutions.com.